Good morning. Welcome to the BYU Marriott Real Estate Webinar Series. My name is Barrett, Slade, Professor of Finance, and the host of today's webinar. Before I introduce our guest for today, I'd like to invite those of you who have questions to, as we go along with the presentation, go ahead and click the Q&A button at the bottom of your screen and type those in, and we'll take those as we go along through the discussion today. So today we have with us Mr. Clayton Wyatt, the co-founder of Vesta Ventures, a venture capital fund investing in PropTech sector with a focus on platforms at the intersection of residential real estate and technology. Clayton, it's good to see you. Welcome today.
Yeah, thanks so much. Yeah, great to be here. Thanks for having me.
Oh, you bet. We're excited. So just take a minute or two. Tell us a little bit about yourself, a personal note. Everyone likes to get to know a presenter, and then go ahead and dive into, we are excited to learn more about PropTech, kind of a fast-paced, exciting new area. So go ahead and take it away. And thanks again for being with us.
Yeah. Well, absolutely. I first have to say, thanks to you and to BYU. This is a phenomenal network of people, and I accidentally happened into this space. I was focused on BYU because I knew I could get to the mountains and snowboard. I think I told you I always viewed that I did undergrad snowboarding and I did my MBA at Pepperdine and went surfing. But along the way, somehow I was lucky enough to look at real estate, have you as a professor, and get into this space. And really technology kind of came as I was telling you earlier in, I think, your first course in syllabus, where you the first time I heard in a sentence cap rates and crystal balls and the same thing. And so Argus and crystal ball, those things that we learned as technologies in that class, I think was really foundational. And so when I came out of undergrad at BYU, really it was a result of those classes, that network, that I went into commercial brokerage early days. It was actually not in residential, it was in the retail space. And we had a partnership. I worked for Staubach companies, which ultimately got acquired by Jones Lang LaSalle. And we had a partnership with Cypress Equities, and we were at the financial crisis. There was a lot of these distressed big box retail boxes. And so what we did was we actually had an engineer that we hired to map out all the distress across the country in the big box retail space. So this would have been like the Circuit Cities, the Merbins of the world. And we were able to target those because we had a partnership with a private equity group that wanted to buy distressed real estate. And so we worked our way through that. I got a little bit of exposure into it, ended up doing an MBA at Pepperdine, and came out of that into investment banking. And the reason I got into investment banking was actually, I think, because of this network as well, that I bumped into someone that was at ICSC and that had been, at BYU in the church. I knew through that network and really had them introduce me to the investment banking world, and was able to get a job in that space. For rightly or wrongly, we covered 90% of my time was in the residential, really the single family rental space. And that was kind of it was kind of at the beginning of its inception. And so the banker that hired me happened to be kind of the pioneer in that SFR space. And we were able to do a lot of IPOs, M&A, capital formation deals. And so, we also had a big influence from technology. And it was, I view it really as like Africa with the cell phone. You were paying, in Africa, you could pay utilities on your cell phone. They didn't have the infrastructure that was built, there. And so you really relied on technology to do some of those things. And similarly, within the multifamily space, that's been around for a while, but the single family rental space didn't have all these advantages of an existing infrastructure. And you were competing in a single family element that was scattered site of, let's say, 200, 500, 2,000, 5,000 units in one MSA. And you had to be more efficient in how you operated, versus in a multifamily building, you can send a maintenance tech up and down an elevator. And so what happened was there was a lot of technology companies coming into the space. And so I didn't, envision my career going into technology or venture capital, but we just saw so many companies that were starting up in that space. And including again, the mentor and banker that I had actually worked with left investment banking to go co-found a technology business called Roofstock, which I ended up coming to as well and doing some of the business development work for, and we're still very active in that business. But it was interesting to see that overlap. And so I ended up starting to do some prop tech coverage at Jefferies as well. I actually left banking and recapitalized an affordable housing tax credit syndication business. And I've seen again, back to this network, I've seen a lot of some of the past participants kind of in residential, in affordable housing, in other areas that we overlap with. So bottom line is we operated that business, ended up selling it to Walker Dunlop end of 21. And as I was getting these opportunities to either invest in as an angel or advise, or to, even co-found businesses that were in the prop tech sector, we just looked back and said, listen, I think we have an opportunity with the relationships with the LPs that we've worked with in the space to start a venture capital fund. And so, Vesta Ventures is really a platform that's focused on the residential living space. And we do that into direct real estate, and we also do that into venture capital. So that's kind of a quick introduction. Hopefully that's helpful for my background. Yeah.
Very helpful. Go ahead and share your slides and dive in.
Okay. I do invest in technology, but doesn't mean I'm the best at operating it. So let's make sure I can do this the right way. There we go. Can everybody see that?
Yes.
Yeah, good. So again, prop tech in the living sector, kind of as our focus, and I'll do a quick overview of how we do that with Vesta Ventures. And again, as I said, we're a fund manager of direct real estate and then venture capital, and really have built the team up of both investors, founders, and advisors that have focus in that space. For example, the LPs we have in our venture capital fund are groups like Invitation Homes, American Homes for Rent, Next Point, and then a lot of individual owners and operators and high net worth individuals that have operated within that space. And we really see a huge opportunity to invest into prop tech at this point in time for a couple of reasons. One, we think the vintage of investments will be really good because we've seen venture investments kind of get to crazy runaway valuations. But given where interest rates are today, if you're looking at that investment, and you can see this in the public markets from a trading multiple perspective, or even just a DCF analysis, if you have a higher interest rate, then the return that you're going to demand for your investment today is going to have to be at a lower valuation than it otherwise be, right? And so we think that that's one. We think the second is that real estate is the largest asset class. So it's a massive TAM, but it's also still in the very early days of adopting real technology in the space. And so we think that we're at that early innings of what will be a long and fruitful super cycle. And so there's different areas within that we can get into of where we invest, but we really just look for areas that we can partner with entrepreneurs and then also leverage the network that we have to look for, an unfair advantage of diligencing. And I think this is an important part, really of real estate and technology as well, which is if you look at technology like a social media platform, a Facebook, an Instagram, a TikTok, any of these, you really have to have millions, hundreds of thousands, if not millions and tens of millions of people adopt that to make that a powerful network and marketplace. And in real estate, it is really different because you have these owners of extremely large portfolios. And if you get even one of those as an early adopter, you have a real chance to make outsized returns in making that startup very profitable. So that's something we really try to lean into. And given that we're hyper focused within the living category, we think we have an advantage to do that. And so, as living sector may be a newer term for many here, but what we're trying to define that as is really anywhere you lay your head. And so as you look at the space, think here kind of on the left side of the page, we've outlined it that it's not just multifamily or single family, but it really should include, long-term rentals, short-term rentals, co-living space, affordable housing, senior living, student housing. And if you think manufactured housing, if you think about that as kind of life cycle, many of us will live or will touch one of these points throughout our lives. And so we think about it holistically as life cycle investing within the living sector. And then within those asset classes or asset types, there's kind of the subsectors of technology, which could be, the landlord or the tenant experience. There's, equity and debt solutions, there's SaaS companies, there's transactional stuff, there's property management systems, there's construction technology. And so, those are kind of the categories that I'll talk about throughout this. As we look into that space, again, it just seems to be that there's a housing problem globally. Everywhere that we turn, there's a housing problem. This is a slide I found kind of on the overcrowding rate. So in Europe, and if you look at it, the darker areas on the map here would be the most densely or overcrowded areas within Europe. And, it seems to be getting worse. It seems to be that every year there's an amount of housing that's needed for a particular area, but we're not able to keep up with that demand and the growth. And, and this is another example in the UK, which we've been spending a little bit of time on because we see the parallels between the institutionalization of residential living in the US and in the UK, and the need for technology companies as institutions enter those markets, that there's a massive issue there as well. I think here the note was there's a backlog of about just over 4 million homes that are missing from the housing market that were just never built originally. And as you look at what is needed, I think today there's about a need of 300,000 units per year, but they're only able to build 200 to 225,000 homes per year. And so you're kind of compounding this issue and you're magnifying the problem. And on top of that, there's a lack of affordable housing at a rate that's affordable to renters or to owners. And so you can just kind of see how this stacks up. And we do think that institutions coming in can help facilitate the either ownership or rentership, but providing more supply in that imbalance. In the US, there's lots of numbers that I've kind of seen thrown around. The one I just picked for here was on the starter home segment, and just being under 400 million units that are unavailable. And kind of hard to read on the slide here, but if you look at in the 80s, I think there was 40% of all homes built were at that entry level starter home point. And today, or 2019, this stat is from 7% of those homes were built. And I'd argue even more today, there's around that or less that are being built at that starter or that entry level. And if you look at, total deficit, you see numbers as high as, 6.5 to 7 million within the US. This is a great chart that I pulled in from John Burns' research, which if you don't use them, they're a great provider of research in the space, and just kind of shows the starts from a single family, multifamily, and manufactured housing perspective. I do think there's also an interesting, component of, these ADUs and kind of, houses that can be dropped into a backyard. So a casita, a mother-in-law unit, an ADU, whatever you want to call it. And there's, states like California that have a massive problem, and they've created better legislation to allow more of this. But the bottom line is, if you look at this chart, we're nowhere near. We had a big drop in, 07, 08, 09, in the financial crisis, of being able to build enough homes. And that's, compounded as we've gone along. We're getting back maybe to a level that's better, but we're still nowhere near where we need to be. And I don't think we're building the right product of housing. And then if you look at, in terms of what's happened recently with interest rates, climbing to, the quickest elevation in rates that we've seen, over the last 2-3 years here, it's put the affordability, really housing cost income for a home buyer to an all-time high. And if you look at the definition kind of on affordable housing, it's really that you shouldn't be paying rent or your debt service mortgage of over kind of that 30% or a third of your income. So, having something that's a 45.9% housing cost to your income is unsustainable, and it doesn't work over the long term. Now, all that said, it creates a dynamic where we've just seen that, this is from Savills, that, let's set gold aside here for other reasons of why that's been a good return, but residential real estate returning, this is over the last 3 years, early 2019 to 2022. And it might be down now in 23. We've obviously seen values decrease, but residential real estate tends to be a very good return on investment, versus a commercial real estate, which is 14.4% here. And it also tends to be a very good hedge in a downturn, right? Because people need to have somewhere to live, and maybe differentiated from, what we've seen in office, and maybe set industrial aside. Industrial's done phenomenally well as well. Office or retail doesn't have the same demand in a downturn, because it's a very resilient asset class, being residential. And as you look at it, again, we're hyper focused within this residential space, and it happens to be that's 2/3 to maybe 75% of the overall commercial real estate market. And as we look at that and kind of dissect it, so if you say the global real estate value is about 380 trillion, global residential living is about 290, just under 290 trillion, which is a massive amount. And granted, not all of that is going to be investable real estate, but there are technologies that service both owner occupants and institutions, and just the residents living in those units. And so what we really believe is that PropTech, again, is at these early innings of a growth super cycle. And as you kind of categorize and break down some of those segments, it's really impressive. Home services, $600 billion a year sort of segment. Residential construction, nearly $1 trillion. And this is just in the US. Transaction fees, which, you've seen some disruption or, some pressure on that space recently with some of these judgments on, how brokerage fees get paid. But that's a massive segment. Mortgage and finance is another big one. Insurance, and then anything from the leasing to the property management segment. We think these are kind of large categories that we can focus on, and that technology can really help address. And so, double clicking onto that, kind of the areas that we like to focus on, are kind of here on the slide. So tech-enabled services, where you can improve NOI margins, you can unlock some of these synergies and really help platform scale. There's been a massive problem with labor shortages, and workers that if you can apply technology so that workers can be more efficient, we think that's a highly profitable segment. We've spoken about the housing shortage, but that's a massive opportunity. Interest rates affecting both how owners can either operate or that how they can be profitable in buying, right? It used to be that you could buy at a 4 or maybe a sub 4 cap rate because your cost of debt was sub 2%, and you could securitize, your portfolio, and the appreciation by time you bought it and stabilized it and securitized, you might be able to pull out your whole basis. That was kind of unsustainable. We look back and see, right? And so now, if you can't use that same leverage and that low cost of capital, you really have to look at the operations. And one of the biggest ways you can increase efficiencies is through using these technologies. And then real estate just has notoriously been a very, very slow to adopt technologies and very just old school in terms of how you operate. There's still a lot of things that are done on paper and even just in Excel, right? Excel is no longer a standard of technology. It's helpful, but there's more efficient ways to operate. And then the last bucket here, which we like a lot, is really just sustainability. And I have to say, we look at it in the frame of it's got to be sustainable on a couple different levels. We can't invest in things just because it's ESG friendly or it's a quote unquote impact investment. It really has to make sense. And there are a lot of things that we invest in that space as well. So what I wanted to do next, if it makes sense, and again, if there are any questions, please do ask along the way. But I wanted to, sort of jump into a couple companies that we've invested into through the venture capital fund, and just kind of walk through what those specifically have done in terms of, affecting the living category. So I'll jump in, interrupt me.
Yeah, no, that sounds great. Well, I guess we do have one question here that maybe is a good time to address it. Question is, are there any regulatory challenges currently facing the PropTech industry?
Yeah, good question. I wouldn't say the PropTech, but I would say facing real estate. And so it does affect PropTech, right? It probably becomes an opportunity for PropTech, but there was a pretty publicized or reported on judgment, I guess, that a judge said that in the brokerage space, agents being able to determine both sell side and the buy side commission, there was a group of class action suit against those agents. And so that puts a lot of pressure on an industry that's been able to collect, call it 6% of the transaction for years and years. And I think the only larger lobbying group than the NRA is the NAR, which is the National Association of Realtors, right? So I do think there's regulatory challenges in the real estate space that will hopefully become opportunities for the PropTech space, because you can use technology to go around this. So in an example of that, is there, you look all the way back to like Redfin. They had to kind of, duck and weave a little bit on their model, which was initially, hey, we're going to disrupt this massive 6%. And I think there's a lot of technologies that have tried to enter that space and say, we're gonna disrupt this massive transaction fee. And ultimately, because of that lobbying effort, have just decided, well, instead of disrupting it, why don't we just figure out how to capture a portion of it? But it looks like there may actually be momentum to disrupt that more. So I think that's promising.
Right.
So let me jump into a couple of these, and feel free to ask questions along the way if you're interested or just want to understand it better. The first one is an example of where technology can enable a dynamic yield on a static asset, meaning in real estate, traditionally there's kind of one best use, right, for a piece of property. And if you had a home, you'd say it's for an owner occupant to live in it, or it's for a long-term rental. And the rent on that house, if we're just making it up, let's say it's $2,000 a month. But what we found is if you apply technology layer over that, one company we invested in, again, this is based out of the UK, but they have assets globally, is TravelNest. And the ability for you to look at that asset in a more dynamic way and say, can I earn more revenue from this investment by turning it into a short-term rental, right? And so the CEO here is, phenomenal entrepreneur. He actually grew up in the vacation rental space because his mom and dad had done, a vacation rental for a while. And what they just realized is that it's kind of broken, right? 57% of the nights go unsold. It's a large asset class, but it underperforms its potential. And then in addition to that, on average, there's about 15 different systems and services, either online or offline. So that could be using an Airbnb, but also dealing with a cleaner or a maintenance tech, or a distribution channel like an Expedia, or a revenue reporting system, like a Guesty. And if you add that up, and people wasted or spent a lot of their own times that they didn't calculate into their return, right? And so if you put a price on those hours, it was about $14,000 worth of hours wasted per year if you're a single host operating it. And because all this data is really scattered, here's some examples, right? 15 on average, there was no good way to connect those together to operate it. And so the opportunity for Travel Nest was to come in and really flip that upside down and say, if you could be one, connection point that is a single source of truth for all of that data, be a full stack infrastructure where all these disparate technologies could come together, automate the workflows, and then have a seamless experience, you could do a lot more with that. And so that's what they've been focused on doing. And as you run through it, you could see where these become more efficient, and being able to aggregate the channels together, having a calendar, having confirmations of how your guests interact with the house and with the host really made a difference. And so that's been a company that we've been very excited to invest into, and have seen that industry changing. Right now, they're doing $1 million a month in revenue, about 8 million a month in GMV, and 5,000 customers, 7,000 properties. They've seen a very low cost to acquire customers. And while there was a massive sort of a travel boom, end of COVID and post COVID, and a little bit of a pullback, we still do see that growing forward. And so that's an example again of turning a static sort of asset into a dynamic return using technology. The next one I wanted to talk through is SetPoint, which is really unlocking speed and efficiency for real estate borrowers and the lenders. And so as you look at this space, the problem with this, and specifically, I should say this is kind of focused on the residential assets, and you've seen a host of iBuyers, power buyers, or sellers that really use a lot of leverage. And if you think about, even the SoFis of the world, there's a really good user experience on the front end, but it's surprisingly, simple and, unorganized, or I shouldn't say unorganized, but just inefficient on the back end of how these credit facilities and warehouses are managed, meaning through, paperwork, documents, Excel spreadsheets. And it's a very time consuming way to do draws when you're doing a lot of draws on and off a warehouse facility. Calculations are, prone to error, and the allocations amongst those assets are really inefficient. So the way that they've solved this is being able to institute, to bring in some technology that allows it to be faster, automated, and more accurate. And it was surprising to me the number of facilities that they saw as they were, implementing this technology that had human errors on it, right? We still rely on a human to hard code in what the allocated loan amount is to an individual property on a massive warehouse. And so they've been able to solve this by implementing technology. And they really do this through a couple of different ways. And it's streamlining these facilities that are backed by the assets for the lenders and the ultimate originators. And one is through this collateral manager. And so the workflow to fund the assets and to store the data and the documents is all in one place. And sort of instead of emailing back and forth all the information related to one house, which is a tiny piece of a very large warehouse that can have errors in it, they're able to do that in one central place that's then automated on funding. Being a diligence agent that allows very quick and accurate document review. Because again, if you click back out and say, let's say you have $100 million warehouse that you're funding, several hundred individual homes on one facility, well, you still have to deliver maybe 10 or 20 documents per home to check the box on making it an eligible asset to fund. And if you do that without using technology, it can be very slow. This also allows for them to manage the portfolio more efficiently, again, to get more efficient on how they draw and the time between fundings, and then certifying the calculations and being a paying agent for these borrowers and the lenders. And so this kind of gives a quick example, which don't have to go all the way through, but bottom line is from with SetPoint and without it, the impact to funding ops, the allocation, the diligence, and the draws is significantly better. And so we like that investment a lot. This is one that came in pretty early days, and again, we had an unfair advantage of where we kind of saw where the market was going and we're able to fund into. I know we're coming up a little bit on time. I can try to be pretty quick through this one, but want to make sure I just pause if there's questions, Barrett, from the group.
Yeah, there is one here. When trying to create a single source of truth, what solutions or alternatives have you seen when some channels don't have APIs or offer access to their data?
Yeah, it's a good question. And so, a lot of this actually comes in the form, I think I'm assuming that's specific to SetPoint, so leveraging, technologies within AI, for example, right? There's oftentimes these funding agreements, these loan agreements can be, 300 to 400 pages, and being able to, quickly digest that and make it an accurate framework of, for example, debt covenants. It's been difficult to do manually, but the technology is now there that you can digest a very large loan agreement and come up with a debt covenant structure that allows you to understand when and you're in compliance and when you might have tripped something. And so it's really trying to figure out the way to digest that. So if it's not an API and those links don't even speak to one another, it's the ability to use other technologies, for example, AI that can kind of digest it and put it into a framework that makes sense.
Yes, interesting. I've been your thoughts. You brought up SoFi. They have just a real nice front end, but they've been from my understanding, have had some struggles, losing quite a bit, and it's kind of surprising to me that the back end just seems to always be so slow to come together. The front end is really nice. It seems really slick, easy, but the underwriting process has probably been lacking on the back end, right? And so
Yeah, I think that's right.
Is that just the natural? They're quick. They wanting to get it. They want to get out. They want to get out in front. They want to capture opportunities, but they haven't thought and invested in the back end as much. So
yeah, I don't know, but my guess is yes. What we've seen, if you can create a very clever UI and you can capture a lot of people, into any technology. I don't want to say, the fake it till you make it, but there's a lot of technology companies taking a lot of money that have to deliver very high growth KPIs. And so they'll do, maybe a lot of things they wouldn't otherwise do to get that front end sort of funnel built so you can capture a lot users, and then you kind of manually work it on the back end. And so I think there's going to be, more and more focus on making sure that it's sort of a holistic technology that delivers real value to investors.
Here's another question, if it's okay. I don't want to
No, please.
interrupt you. You're okay? Okay. Question: how is blockchain technology being applied in real estate transactions?
Yeah, blockchain's an interesting one because, again, if you look at sort of, at least from here, I'll take this off quickly. It's something that we've seen trying to be applied even within like the transaction for homes, right? And if you can have the ability to do that very quickly, I think it's really interesting. I don't know that I've seen it at a point that's been widely adopted yet. So two issues. One is, title takes a long time, right? And even you can purchase a car much quicker than you can purchase an asset and actually get title done on it. The other thing is, real estate assets are large and expensive. And so if you can democratize that ownership by actually breaking it up into smaller pieces of ownership. And we've done this actually through the Roofstock platform, right? We sold these in a structure using blockchain where you can sell an asset into, $100 or $1,000 slices. And so I think that the technology is really good and promising if you can get it adopted in a way that makes sense for scale. Now, obviously, with SBF and the issues that we've seen in that space, it's probably going to slow down the progression of it. But I do think that there's an application in it. I just haven't seen one that we've been able to back yet. That makes sense. But it's an interesting sector for real estate for sure.
Probably on its way, right? It's just
Absolutely
still taking a while. One other question: what privacy concerns are you seeing associated with the collection and use of real estate data?
Yeah, where I'm seeing it more is on the institutional side, where that data is very valuable, right? And so I would say the static data in terms of, a home's square footage, the age it was built, what price it transacted at on a certain date is largely public data, or you can get it through the MLS, you can get it through different service providers. The other piece of that is more the dynamic data, which is what should a house sell for today, or what should it rent for today? What are the operating expenses of that asset today? And there are a lot of institutions that have that information that's very valuable. And if you have an aggregator of that data that's collecting it from the institution, who owns that? And the institutions are increasingly either, becoming aware, becoming more focused on protecting their own data, or making sure that it's aggregated. And then, if it's being used by either competitors or others in the space, that, they're either getting benefit of that, or it's used in an indexed way that, their privacy is protected.
Right. Okay. Interesting. So let me ask you, what's your thoughts about, talk just a little bit about AI a little bit more, and kind of what opportunities you're seeing in the PropTech area.
Yeah, again, this is a super interesting one. And I will say, in no way am I an expert in AI. And I think, first is trying to understand what AI actually means, because, I think there's a bubble in AI, to be honest, right? Like every company that pops up, because there's been so much, there's been a high adoption rate with ChatGPT. And I think that it's really interesting, but I think you need to really understand what the technology actually is. We just saw, I think it was like a $200 million acquisition by Airbnb. I don't know that business, and so I don't know the ins and outs of it, but clearly there's some value that people are paying real money for if you can create a product that works. Unfortunately, what we've seen more of when you dig in is actually a collection of things that free technologies or very cheap AI technologies already provide. And so some of these AI, sort of real estate companies are just aggregating other existing opportunities. Now, what does that mean for the sector? It means that I think it's going to be very efficient going forward. Again, as I mentioned, if you can digest a 300 to 400 page loan document and get a clear outcome of, what are your debt covenants and how do you navigate that and how do you allocate, your individual loans more efficiently, then that's huge. And so we've seen one that's like, listing, sort of assistant with AI. So if you just say, hey, this is a, 3-bed, 2-bath, 1,500 square foot house in Atlanta, Georgia, and it's got, sunny, a lot of sunlight. It's got a washer dryer. It's, LVP flooring, and you give it a couple parameters, and then the AI can actually give you a ready to serve up property description that you could stick on, Zillow or Craigslist or whatever. The other one, that's really interesting. Maybe I'll actually just skip forward to this because I think it's there we go. Can you guys see that one? Great. So
yes,
let me skip back. We spoke about data, I think a little bit already. And so I'll skip past Happy Go. But I will just say on this one, the one of the problems with the data and everything else is that, in the car world, you could be really close to understanding what the value of something is. In the real estate world, we're still a ways away. And if you said which one of these assets is a Class B asset, the punchline is they're all Class B, and it's really hard to tell, right? So that's a difficulty. But speaking of AI, let's go to this company that we invested in called Showdigs. And what Showdigs is doing, it was interesting because we kind of surveyed the groups within the space and said, what are the 3 biggest problems you have? And those were, it's HOA, it's utilities, and it's squatters. And, 2 out of the 3 at least can be solved through AI. And one of the things that Showdigs was able to very quickly spin up because of that insight was something called AI Listing Shield, which is powered by AI. And what was going on, particularly in Atlanta, is that there was a very professional network of, fraud that was going on, which is because there was a technology that was allowing, self showings, right? There's a box called Rently that hangs on the door. You go on an app, you see what's available, you have a code, you open up the Rently box, you get a key, you go in the house. Because there was access, these networks were making listings on Craigslist that were fraudulent listings and pretending to be the landlord, giving you all the correct information to access the house. And once they did, they would then collect a deposit and maybe even collect some rent. But when the landlord shows up and says, hey, this is my house, what are you doing here? They show them a fake lease. And so it was buried, and then you have to go through a judicial process to get the squatter out of the house. And it's very complicated and tedious. And so, what they were able to do was use AI to scrape the internet and find fraudulent listings and then immediately remove those listings. Well, but now, because there's also AI to generate listings, they would come back and ultimately put a new fake listing up. And so it was kind of like this cat and mouse game, but it did, you have to do a couple of things. One, you have to, identify its fake listing through AI. 2 is have the removal of the listing. But 3 is really, you have to verify the person that you want to allow to see your home. And so there's a couple ways that AI has been able to do that. But then at the end of the day, I hate to say it, you still need to have eyes on the property. And so what they found is, they create a technology that allows you to instantly, kind of like an Uber for real estate agents to do small jobs, that you could say, hey, I need an agent for $50 to go do a site check or to show up and let this prospective tenant into the house. So anyway, that's one example of how AI, I think, has been
It's a
utilized.
fascinating area, AI fighting AI, it sounds like.
Right. Yeah, exactly right. So like that's the thing. It's a wonderful technology. It's all about how it's implemented and used. So
That sounds great. Well, Clayton, I wish we had more time. This has been absolutely fabulous. Thank you so much. I want to give you just a minute. I typically end the webinar by giving our guest an opportunity to share a nugget of wisdom or two. We have students as well as young professionals on the call. You've been down the path a little further, and just take a minute or two and share something that might help them as they try to advance their career or get started in this real estate world.
yeah, sure. And I guess with the caveat that there's a lot that can change and go wrong sort of in the journey, but the biggest thing that I would say is that this is such a phenomenal network. And even as I was going back, sort of prepping for this, and I needed to pay attention more to the webinars, but they pop up in times that you're distracted. And so I went back and actually looked through a couple of these. And there's folks on there from Ashley Powell, that was at Property Reserve, that has done stuff in this space, to I forget the gentleman that's at Graystar that was doing build to rent. I just hosted an event with some of our investors and operators, and one of the guys from Graystar is there. So there's connectivity, right? I just think you have to utilize that network to sort of find the ways to, and it's a very open network if people are just asking, right? I don't think it should be used just to kind of bombard everybody, but if you have a very specific ask, it's a very open network and very friendly group that exists kind of in this diaspora of like all the people that have gone to BYU, that are in real estate and that are entrepreneurs. And so I think utilize that is number one. Number two, I think, is you have to be an absolute animal early days as you're starting out your career. Like that is the time that there's kind of these different like phases of life, right? And I think if you can learn as much as possible in those early days. I mean, I remember getting grinded as an early banker, and you just learn so much. We're actually at a point in time where everything is harder to do because rates are higher, and that really impacts real estate. But the upside of that is if you're starting your career now, it's good that it's harder because you'll learn a whole lot more. And so I just think you have to be an animal and like very aggressive in learning as much as you can so that it'll pay dividends later in your career. And I've seen that be true, within my sort of journey. And I think that, again, speaking to the network and kind of connecting where, I still find that it's really, it's a small world within real estate. It's even smaller within, either the LDS community or the BYU network. And there's connections that pop up that, it wouldn't otherwise have if I hadn't been fortunate enough to go to BYU and to be focused on real estate. So that's what I'd say. I don't know. Hopefully that helps in some way to someone here, but really appreciate being part of that and being able to come back and join this webinar.
Great. That is wonderful. Great advice. Clayton, it's so good to see you again. There's a little gray going on in the beard here, so I think that dates us both. So anyway, it's so good to see you, and best of luck, and we'll catch you maybe at the next conference, or if you're on campus, love to see you sometime. So and to everyone on the call, thanks for joining us. This is going to be the last webinar of this semester. We're going to be entering in the holiday season, and it gets too crazy with finals and everything. So we'll start again in January. We wish you a wonderful Thanksgiving and Christmas season, and be safe out there. And we'll see you next semester. Have a great afternoon.